But whether you talk about the absolute outlook for equities or the relative outlook, so there are a lot of opportunities on a relative basis. And the biggest one I would say is food and beverages. That's the very defensive sector, get absolutely pulverized over the last 2 years because you had strong macro, you had tightening risk premia. If indeed, and that is the key question on everybody's minds, we were just in Tokyo and Hong Kong, today we're in Singapore, the only question we're discussing is the US labor market turning down, i.e. is unemployment rising? We think it will be. A lot of the forward-looking indicators suggest that. If so, there's a lot of scope for outperformance for these defensive hiding places.
Let's talk about the banks. In a post-Credit Suisse, UBS environment, how would you describe the financial stability picture, and what sort of job are the big European investment banks doing in the current environment?
So again, I think it depends on whether you think about the business model or the market outlook. Right. So the business model is far safer, and I think that's also a key discussion point with investors. If there's any kind of macro trouble, the multiplying and intensifying effect that in the past you had from the banking sector is far less likely to materialize. These have far safer balance sheets. Regulation is on a far more vigilant kind of state. So therefore, they are far less troublesome than they have been in the past, if you think about the great financial crisis or the euro area crisis. Does this make them good investments? That's, of course, the key question for. I don't think so. The sector is at a 5-year high relative to the market. It is very vulnerable if bond yields decline and the risk premium widen. That's our base case, because that's what you get if the labor market in the US weakens. So therefore, we'd say they are safer, yes, but at current levels, they're not attractive investments.